All right, now we're going to hear from the biggest U.S. provider of retirement plans for teachers and academics. TIAA-CREF manages plans with $434 billion in assets, serving 3.7 million people. Our senior markets correspondent, Julie Hyman, is in the newsroom with the chief investment strategist, Brett Hammond. Hey, Julie.
Hi, Lisa. Thanks so much. And I want to start off with really what is the hot topic today, besides the overall stock rally, General Motors. We've been talking a lot about it. Now, Brett, I know you can't say specifically, you can't talk about a specific stock and say whether you guys are buying it, but just talk to me about the implications for GM's IPO and what it means for the overall U.S. market.
Well, this is not surprising that you'd see a kind of jump on the first day, but this is a big deal, obviously, because we have a company that has been completely transformed. You wouldn't, as a stock analyst, you wouldn't analyze it at all the same as you would have 5 years ago. And we're starting to see the return of this company has big implications both for investing and for the federal government, because the federal government has a huge stake in the success of this thing. It's actually great news.
Does it tell us anything about the state of manufacturing in the U.S., or is this really a very GM-specific story?
Well, I think it's really a credit story. I mean, there are definitely some manufacturing implications, but it's very much a credit story in the sense that it was the credit markets that helped drive down GM in the first place, but it also provided an opportunity for GM to really finish fixing what it had started to fix over the last 10 years. And so it was able to do it more rapidly, shed the things that it needed to shed, and now get back in the market so that it can bring some of those manufacturing changes to the fore. But it was really driven by credit, and hopefully that has been fixed.
Well, let's talk about credit more broadly then. Obviously, the Fed has been much in the news recently with quantitative easing round 2. Are they achieving the goal? I mean, the original goal, if you remember, after we went through the financial crisis, was to open up credit once again, to get banks to start lending again. Is that happening? Is QE2, I mean, it's early days, is that starting to work?
Well, I think the jury's out. And on the other hand, the big companies have been able to issue debt and to get lending from banks. Banks are being willing to do that, but they haven't been willing to do that for small firms, for consumers, even with tremendously low interest rates, all-time low interest rates. It's still really hard to get credit. Banks are just sitting on their cash. That's what QE2 is supposed to address, and we haven't seen that happening yet.
Do you think it will?
I think it will. I think we're going to see a gradual, slow change. The good news is that if we hadn't done QE2, we'd still be in the soup. And even though Happy Days,
so you think the Fed had to do it?
The Fed had to do it. Happy Days may not be here again, or they may take a while to get there. But if we hadn't done it, we'd be very much in danger of falling back into that credit crunch and recession that killed us before.
Well, what about the concerns, though? As you probably know, there was this open letter from a number of well-known economists that came out last week, an open letter to the Fed saying you shouldn't have done it. You shouldn't have done QE2. It's not going to be good for our economy. It's not going to be good, a lot of critics have said, for the dollar, and inflation is going to get out of control. Is that a concern of yours?
Well, it actually isn't. I think if you take some of the points you just made, our industrial capacity, our labor markets are so underutilized at this point that there's so much slack. It's very hard to imagine anybody being able to dictate prices or push up wages at this point, and that's the generation of inflation. In addition, I think the dollar's been declining since 2002, and this action certainly won't push it back up again. But then I don't think the intention was to push back the dollar. I think the intention was to get credit moving again.
So let's bring all of this to your investing and what you're seeing right now. Stocks. Do you think that U.S. stocks are a good bet right now, and where are you sort of looking within the U.S. stock market?
Well, as far as the market as a whole is concerned, we've seen a really choppy market this year, and it's choppy from day to day, from week to week, month to month, quarter to quarter. It's been choppy. Just think of the second and third quarters. I think that's what we're going to continue to see for a while. You know, the Philly Fed just came out with some good news. The Conference Board just came out with some good news about leading indicators. That's great, but I still think it's a slow slog for the stock market and for investors.
And so what's your view on what to do with U.S. stocks? Are you staying then more defensive, so to speak? Are you looking more at the staples and that type of investment, or are you looking more, trying to get more into growth?
Well, I think that we've seen some growth success. What I think, though, is that you're going to see more differentiated performance. So stock picking is going to be extremely important in this period because you're going to see continuing choppiness. So I wouldn't just go for growth. I'd go for growth companies that have a great story that may be undervalued, because the stock market as a whole has really come up in the last several months. And
do you think it's fairly valued?
I think it's close, and I think so. I think what we're going to see is a lot of choppiness and volatility, unless you start to see more of the fundamentals getting better and better, which we're only beginning to see now.
Well, you know, the Wall Street strategists that we survey, on average, are looking for an S&P 500 north of 1,200 by year end, so just in the next couple of months. So if you think the S&P is near fair value, do you think that that is a realistic prediction? And these folks are pointing to things like profit growth, which has been pretty steady throughout the year.
Yeah, the issue with profit growth is that we've had great couple quarters. Even this quarter beat expectations. The problem is that it isn't as good. This last quarter, third quarter, wasn't as good as the first two. So we're beginning to see some tailing off of those profits. That's partly what I mean by the fundamentals. We have sort of moribund economic growth going on too, and high unemployment. Where I think if there is a case to be made for a rally, I think it's in the emotional space, and what I mean by that is this. Emotion always plays a role in markets. We know that. Things overshoot, undershoot. But I think right now what you see is the fundamentals not really being in place to support a major stock rally. But what you have seen is any emotional news that comes along, or anything that could be turned into an emotional response, is being. So
do you think over 1,200 is a realistic goal for the end of the year?
Well, if it happens, it's going to be because investors sort of get euphoric about something. You know, maybe the Irish bailout.
Well, I was going to say, if that gets sort of sewn up, is that then enough to see a big rally in stocks?
I think we've had some good news.
I mean, that seems to be contributing to some of the gains we're seeing today.
Exactly. That's just what I was going to say. I agree with you. It's already been seen in some of the gains. I think it will help. The problem is that enough? Don't forget about Greece. There's still a non-zero probability that Greece is going to default. If that happens, I think you see an emotional response in the other direction.
So just quickly here, looking ahead to next year, you talked about the fundamentals not really being there. What would be a fundamental catalyst or catalyst that you're looking for, just quickly here?
I think it's the consumer. If you start to see the consumer getting back on board with spending, we've seen some good retail numbers, but if that sustains itself, which it hasn't done so far, I think you can start to see some light for economic growth, for stock gains, not just in the retail sector, but in a wide variety of sectors.
All right, Brett, thank you so much for joining us. We appreciate it. Brett Hammond is the Chief Investment Strategist at TIAA-CREF. Lisa, back to you.